Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. In today's episode, Portfolio Manager Dan Dupont provides an overview on how he's navigating the current market landscape and offers insights into various global trends and sectors. Dan discusses investment opportunities in China, where large-cap stocks are severely undervalued, he says. With minimal downside risk, these investments have rebounded faster than expected, and Dan's patience has paid off as he's captured quick gains once the market has corrected. Dan highlights the importance of recognizing value in global markets, especially when domestic opportunities are harder to come by. Dan also discusses the challenges in the U.S. market. He touches on the difficulties of finding attractive investments in this space, characterized by high valuations and inflated margins. This has driven him to focus on global opportunities in more defensive sectors where strong balance sheets offer stability in uncertain times. This podcast was recorded on October 1st, 2024.
Hi, Dan. How are you?
Hi, Pam. How are you?
Good to see you. Let's begin actually with, it feels like it illustrates what you do that a lot of other people don't, but China was a surprise. I mean,
Yes.
I think a lot of people did not see and had almost from an investment perspective left it for dead. It rose again last week. What does that mean for you?
Yeah, so that's just one example of the type of positioning that I have that sometimes kind of gets misunderstood. I did have quite a few positions in China across my funds, even in Canadian large cap fund. And the way you get to a position in an area like that is just that you wait for valuations to come down, and then they're just not cheap enough, and they go down and down and down. And some of even the large caps over there were 7-8 times earnings, a lot of cash on balance sheet, double-digit growth on the top line. So what I'd been doing was just, waiting for these stocks to eventually revalue a little bit. And some of that happened quite quickly. You don't always, expect that, and certainly did not. I was willing to be very patient there. But, when you can't really lose too much and you have a bit of patience, it eventually pays off. Here, it paid off a little bit quicker than I thought. But, it's just, it's the market.
In another way, which is not as fast and quick and probably as surprising, what has the broadening out throughout the course of this year, some fits and starts, but now a serious and sustained broadening out, meant for your funds?
Yeah, so if we take a step back, for me, it's been really difficult to find companies that are really attractively valued anywhere. Mostly in North America, I'd say the US is pretty egregiously valued in terms of general margins are high. Multiples are high across the board. So as I go through our research notes and meet companies with the analysts here, I find it very, very difficult to find anything of interest in the US. I have about 2.5–3% in my core positions in large cap. I have a decent amount of arbitrage, but that's a different animal. But in terms of undervalued securities around the world, it's been, yes, the broadening is interesting, but there's a lot of companies that were fairly valued to overpriced that are just a bit more overpriced than they were. So for me, it's just I just keep looking around the world to find the best opportunities anywhere. And geographically this year, it took me to China, which, as we know, is an emerging market, very unorthodox move for me, but I just thought it was so undervalued that at some point it was starting to be interesting. It was a bigger position in North Star and Global Value Long Short, but it also was a position in Canadian Large Cap Fund. Now, what's left in terms of cheapness, because the broadening is making, as I said, a lot of things even more expensive. I find opportunities this year in a bit of healthcare, but staples is really an area where I'm continuing to increase my positions because it seems like generally people are not expecting even a slowdown anymore, not even a recession. Everything's priced for perfection. I feel like we haven't had a credit cycle in 15 years, which is creating a lot of interesting discussions with our analysts on my
We've
part.
had recessions, but for different reasons, like sort of it's.
Yeah, that's why I call it that's why I talk about the credit cycle. We had kind of a recession, but frankly, the government came in and the central banks came in so aggressively. Fiscal and monetary really kind of precluded any kind of cycle. In 2020, it lasted about 3 weeks and a half, that bear market. And so a lot of our analysts and a lot of investors in general have never really seen a downturn where that implied or that had as one factor, a pretty significant contraction in credit and a pretty important widening of credit spreads. So we haven't seen that in 15 years. So where does that push me? It pushes me in areas where things are less cyclical, balance sheets are fine, and there's been some factors pushing valuations down. And that takes me a lot to staples, including tobacco and alcohol. And one of the big factors that has pressured valuations in the last year and a half is the introduction of GLP-1 drugs, the weight loss drugs that has made people very nervous about the growth prospects, or even reduction in consumption of alcohol and tobacco, if maybe these drugs are very efficient in reducing people's willingness or desire to consume.
Even alcohol.
Even alcohol. I mean, the U.S. is a very simple example of that. I understand why people were very concerned about it a year and a half ago. I was also concerned because the numbers are quite staggering. In the U.S., the top 10% of consumption of alcohol, top 10% consumers of alcohol drink 90% of the alcohol. So if you put, a few percentage of these people on loss reduction drugs, and it actually reduces their willingness to drink, then you have a lot of you have big drops in consumption. And tobacco was a bit of the same.
Really?
So we've been looking at that for a few quarters now, and the signs are that there is a tiny bit of an impact, but we can't see anything very material for now, at least. So a lot of these tobacco and mostly alcohol companies now, the last year, have had multiple contraction that is quite material. And I just bought a French-based liquor company, one of the smaller ones, at 16 times earnings. It's never traded anywhere close to that level in 25 years. So there's a lot of fear out there, and I think it's time to take advantage of that, and I am.
So that's sort of some really interesting aspects of the staples beyond the grocery stores, which of course are also important, but that is a really interesting inside look. Tell us a little bit about the strategy sometimes of incredibly low valuations for good companies and how that sometimes works out. I mean, I've heard other fund managers talk about this a little bit. It sometimes works out that actually the companies are taken out, which is good for the people who own your fund ultimately. But those do sometimes happen, maybe not because you're aiming for it, but because they're good companies that are cheap.
Yeah, that's exactly right. So Imperial Brands would be right in there. Eventually, some other large tobacco company will probably take it out because it makes so much sense, but who knows when and at what price. But it certainly is a kind of a call option that you have when you own a security like that. But I'd say it's been a tough time to be kind of a valuation, just value-oriented investor in the past 10, 15 years. I'm more of a downside protection kind of guy. And so for me, it's been a little bit easier. I've had the pleasure also of covering, sectors that were kind of value sectors while I was covering them, but that turned out to be very dangerous places to be. So I covered the banks in 2008. And so that was a fantastic experience to me, to differentiate between, what a value trap can be and what an actual undervalued security is. So if it's worth something to a bigger company, it will be taken out. But certainly if it's massively over-levered, balance sheet is everything in investing. So, some great lessons there when I was an analyst.
What do you think of financials right now?
I'm staying mostly away. Unless it's kind of a Fairfax, which is again, I think in my top 10. But other than some very stable PNC, life cos, very long duration on the balance sheet with rates that are still somewhat elevated, probably coming down, but at some point. But I see some risk there. I see the risk of the Canadian consumer level. So banks, I'm staying mostly away from. So, the cornerstone of my investment process is to be patient, let the market come to me and wait for opportunities that are fairly obvious to me. And so I'd say right now it's more in the staples area. In 2020, it was quite easily oil and gas. The difficulty in that patient process is to really wait for the market to really come your way and to buy at a very cheap valuation, which was the case for oil and gas in 2020. We made a decent amount of money there. And now there's just isn't a lot of volatile, more cyclical areas that are that attractive. I'm finding, a stock here and there that I'm adding to the fund, but really in general, it's mostly the defensive areas. And financials right now, I think the difference between perception and reality of Canadian financials generally is a bit wide at this point. Everybody thinks that Canadian financials are super high quality, and I saw them through 08, 09. I think there's a lot of things that people don't really understand, that we came really close to some calamities. U.S. financials are in way better shape. The ones that you would want to own are not cheap at this point. And in Europe, it's still it's difficult to find one where you can really trust the balance sheet, even after 10 years of these being really zombies. You could see it in 2012, 13, when the European crisis was there, and in the real estate mostly. You could see they were going to earn $1 billion a year and write off $1 billion a year for years and years and years, and that's where we are now after 10 years, and it's not clear it's over. There could be another 5-10 years of that. So I'm basically, for the most part, staying clear of financials.
There's some great questions coming in. I'm going to put those to you. I just want to quickly ask you about the alt fund that you run, the Global Value Long Short. Again, sort of within that, what are you enjoying looking at in terms of opportunities and having that sort of structure to work with?
So on the long side, there's just a bit more, bigger positioning in the areas that I think are interesting. So as I said, staples, some Chinese equities, and outside of that, just a hodgepodge of more defensive names that we think are attractive generally. And on the short side, it's a bit more narrow in the most obvious areas of overvaluation relative to where we were in 2021, let's say. I remain of the idea that there's been 3 great shorting opportunities in the last 30 years, 1999, 2021, and right now. But 2021 had more areas that were bubbly. So you had, here and there, 3D printing, you had marijuana, you had electric vehicles and lithium, and but also crypto, and also, some technology. But now we really have kind of a more narrow area in AI and or crypto together. And then outside of that, what I'd say is getting a bit more obvious is kind of the long-term winners, some stocks that are trading at 50 times earnings, that are, low volatility, that are good businesses. But if you really do the math, these stocks could be flat for 20 years and, at the end of it, be basically fairly priced if everything goes okay. So
these are AI stocks, broadly speaking?
Sorry?
These are AI stocks?
No. These are very, very stable companies. So I was saying AI and crypto are some very volatile areas where there's overvaluation. But on the side of less volatile areas, you have these long-term winners across geographies, across industries. In Canada, no matter what you think of these companies, what they are. They're just up and to the right, never have a week where they actually seem to ever be going down. And they just got more and more and more expensive over the last quarters and years. And I think we're starting to see some opportunities on the short side there, as people just say, well, I'm never going to sell this company. It's just, too high quality. So a bit of complacency in my view.
Some great questions. Let's put some of these to you. So one of them, let's begin. So oil and gas, you were mentioning oil and gas earlier and what it meant to you. How are you feeling about oil and natural gas at this time?
Very quickly, it was an obvious area to be very aggressively buying in 2020. They were all trading at 0.5, 0.6, 0.7 times book value. I'm not that smart. Sometimes I simplify things a lot, maybe too much. I don't know. But if you look at oil and gas companies in Canada right now, these are still very asset-based businesses. You need to invest a lot of capital to take the money out of the ground. And so when these things are trading at the large caps, a lot of them are 1.8, 2 times book value, which tells me, there's a lot of confidence in an oil price that's going to stay at a high level. And I can't underwrite that in my process. I need downside protection. And so for me, I need to wait for a market that comes my way. And I understand that some people are invested there. The supply demand picture looks pretty good. But for me, it's just not my game. If we're kind of in inning number 7 of 9, if we use the baseball analogy, it's not, for me, it's not a place to be. So I'm I don't own any oil and gas names that are pure plays in large cap. I do own some pipelines because of the interest rate angle when I bought them, and I still think they're interesting from that angle, where people thought rates were going to be high and high for a long time. And so they started just, selling whatever was interest rate sensitive, like pipelines. And so for me, that was a great place to add. Utilities are a bit the same, not that's outside of oil and gas, but they were an interest rate play that became, for the most part, undervalued, and some of them quite undervalued in the last year. So utilities is a big part of Canadian large cap funds still. And then we'll wait again for the market to come our way when there's a bit more concern about the economy at some point. Who knows when? Maybe, is it a year, 2 years, 3 years? I don't know. But at some point, I think there will be demand for these defensive names, which are not cyclical, and eventually some pressure on interest rates, which would be really good for them, at least on a relative basis, if not on an absolute.
Fascinating. Okay, here's a question that I'm sure is sort of what you think about all the time. Maybe you could explain it to us. Can you talk a bit more about the difference between a value trap and a legitimately undervalued security? I mean, this is a big piece of the story.
That's the art in the investment process that I've been following for 15 years. I need to differentiate between these two. I'd say to start with, the balance sheet is incredibly important. Then the quality of the business itself, how stable are margins, how sustainable is the pricing. So it's all subjective at the when we're answering that question. How is this business going to survive over the next 5, 10, 15 years? Does it have kind of a moat? Can it really defend its turf? And so, as I said earlier, I think I've had the best experience in understanding where, with financials, with banks specifically in 2008, the difference between a value trap and what's fundamentally a good business. And so I'm not trying to be too clever. Banks are really levered entities, typically 20-to-1 asset to equity ratio. So for every $1 of equity, you have $20 of assets. It's very easy to shoot yourself in the foot and wipe out your earnings for the whole year very quickly, if not even more, if not have a decent number of write-offs. So, when I look at National Bank and I see that 10% of earnings are coming from Cambodia, with, assets that have been just growing explosively there, indebtedness is growing explosively over there. These are the types of little things that I try to really understand and make sure that, we're not, I don't care if I'm paying 5 times earnings for something like that when it can actually blow up in your face. So it's an everyday analysis. It's very subjective.
So a question here, and this may go, just broadly to how your approach works in, uncertain moments ultimately. So geopolitical concerns related to China are they impacting your view on investments in that market? So maybe China and maybe just geopolitical events more broadly.
Yeah, of course, geopolitical events in China has been impacting my view of investing in China. I think that's the reason why these stocks got to the level they were trading at up until basically last week. But to me, that valuation was worth that volatility and that uncertainty. And the maximum points of uncertainty historically have given us some pretty good entry points in a lot of geographies, a lot of sectors. So for China, I thought, the relationship between that uncertainty and the valuation and what could actually happen was very, very attractive. I like call options on the flip side. As I've said many times, I don't think I've ever been this defensively positioned ever.
Really, I feel like you should repeat that, because that says quite a lot. You've never been this defensively positioned.
Yeah, not even, January of 2020, I was very defensively positioned, but now I have a lot of arbitrage on, which are companies that are being acquired for a fixed price. So when volatility comes, like it did in March of 2020, these stocks go down 0.1%, are very liquid. You sell those, you buy other stocks down 20, 25. The really difficult part, as I said earlier, is to be patient, let the market come your way. And once you're there, I've realized over time, there's not a lot of people who are willing to pull the trigger like I am. I can be very, very courageous in times when there's a lot of uncertainty, but to get to that point where you have the ability to be courageous, you need to be unbelievably patient. And that's, again, what I'm doing right now in this market. Interestingly, this year, my performance has been pretty decent. I think the market is slowly starting to sniff out that at some point there will be a slowdown of some sort, maybe even a recession, because some of these more defensive names that I've owned for a while are perking up. There's a bid in there, and other areas are becoming a bit more wobbly, where there's been a lot of momentum. So we'll see how things evolve. Interesting little tidbit as well from my perspective, which historically has been kind of a signal, but the inflows into large cap have started again, $3, $4, $5 million a day.
The perfect entree for the global equity plus. Let's talk a little bit about that and how that's worked. And even within this year, it's been interesting because, as you say, Mark Schmel's been up massively through part of this year, maybe the rest of this year. He gave you a little plug, I guess, when we spoke to him in this forum a couple of weeks ago, said, now you should look at Dan. So there you go.
And the genius in the product and the secret sauce in it is the rebalancing. It's just the fact that everything gets rebalanced automatically. It's so difficult to get the courage to move from a very high performing fund into something that's been performing a little less, and to do it very in a timely manner. And that fund does it automatically. And I'm not surprised that the inflows have been this strong. This might be our best launch ever in Canada. I think the fund's easily over 3 billion at this point, 3.2, 3.3. But I'm expecting that to keep growing, and hopefully it does very well for our fund holders. And I think structurally it is incredibly well built for that.
Dan Dupont, it's great to catch up with you, and thank you for your time here today on Fidelity Connects. See you soon.
Very welcome.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.